Today, we are delighted to have with us Sandy Kaul, Executive Vice President and Head of Innovation for Franklin Templeton. The Franklin Templeton Group manages nearly $2 trillion in client assets. She is a board member of the World Economic Forum's Digital Assets Advisory Board and co-chair of the Digital Assets Subcommittee for the U.S. Commodity Futures Trading Commission, or CFTC. Previously, she was Global Head of Business Advisory Services for Citigroup. She holds a Bachelor of Arts in History and Political Science from Colgate University. Sandy, thank you so much for joining us.
Thank you so much for having me. It's a pleasure to be here today.
One thing that struck me about your title is you're the Head of Innovation, which is, I guess, a little bit of perhaps an unusual title for a financial company. So can you tell us what, your responsibility is and, as Head of Innovation?
Yeah, so I think that, when you think about big organizations, there's a lot of pockets where people have great ideas and they really start to pursue new ways of doing their jobs, new ways of using new types of tools like AI, new models that they see coming into existence, like the blockchain-based rails that we're seeing people build digital assets on. And they experiment, right? Experimentation is part of human nature. And in big organizations, experimentation pops up organically if you don't try and harness all that energy and direct it. And so what we are doing at Franklin Templeton is we are really trying to create a framework for innovation where we are really making some bets as to what we think the future is going to look like and what we will need to do as an organization to succeed in that future. We are then trying to channel the resources and the money that's being spent on experimentation into those initiatives that directly support that kind of vision about the future. And then this way, what we're hoping to do is really get more bang for each innovation dollar, really be able to have the entire organization kind of pulling in the same direction, thinking about the same priorities, sharing the same learnings in a way that allows us to really accelerate our efforts and be very targeted. Otherwise, you might have 1,000 experiments and it's hard to figure out which are the 10 or 20 that are going to really succeed, as opposed to, these are our visions for the future. Here are the priorities that we need to make sure we achieve. And here are the projects that are going to really move us in that direction. So we're trying to take a little bit more of a structured approach to the way that we think about and design and spend and pursue innovation at Franklin Templeton.
It makes a lot of sense. I suppose if you have a lot of really talented folks and they're all going off in different directions, I'm thinking of like a metaphor of several horses all running in different directions, and
Right.
You don't go anywhere, and you could fracture certain things. But if someone thinking about it, directing it, and channeling all the horses so they sort of run like that chariot that you remember in Ben-Hur or something like that, that would actually be much more effective. So thematically, what are some of the innovations that Franklin Templeton, you are thinking about for the next 10, 20 years, as sort of the boomer generation, starts to age out, so to speak, and a lot of that money actually goes to their descendants.
That's right. So there's a few things that I think really guide our thinking, Ty. So first off, right, we are all living in a world that has become very consumer focused, right? I turn on my television and everything that's being recommended to me is based on my own viewership patterns and based on my own interests, right? How come when I have my investment portfolio, it's not moving in that same direction, right? So the first thing that we really believe about the future is that investing no longer has to be done at these very generic layers where I just buy into a fund and every person in that fund gets the same service and my portfolio is basically a set of funds. I am really envisioning, and we are envisioning, a future where every person's portfolio is built specifically for them, right? It is based on where they are in their life, what they want to achieve with their goals, what their overall standard of living that they're looking to maintain is going to need to be able to achieve that. What are they looking to do in the short term? What are they looking to do in the long term? What aligns to their values, right? These are all things that I think that my investment portfolio should at least be as personalized for me as my recommendations on Netflix. So personalization and customization of the portfolio, and this idea of mass customization, being able to build a portfolio for every client, that's one of the first innovation themes that we are pursuing. And then the second innovation theme we're pursuing is that I am going to be able within that portfolio to use my assets more effectively, right? Big institutions today are able to lend their assets and earn extra fees. They're able to sweep their money overnight into money market funds that earn them yield. They're able to use margin if they need to extend positions when they have very high conviction. These are all things that, individuals should be able to do as well. It shouldn't matter that I am an individual person and not a big institution. We have the technology today and the ability to deliver that level of service to every individual. And then finally, the third thing is that these new technologies are going to allow new things to be put into the portfolio, right? So, today there's lots of things that people invest in, but they're very hard to trade, right? Think about art and wine. Think about intellectual property, like song rights. These are things that are very lucrative, but it's hard to trade those assets. And we think that these new technologies are going to make that easier and allow us to put them more assets into portfolios. So we're kind of pursuing all those different pathways.
And sort of be a step ahead of the what perhaps you and I remember as just the stockbrokers who were able to, you picked up the phone and called them, they executed a trade, the margins were vast, and now the margins, as a practical matter, almost don't exist. The world is changing, and it's really interesting to see that you're looking at it in a cohesive view. In some of the speeches that you've given, you talk a lot about tokenization of investments for the average investor. So I guess what I want to ask, and for the sake of my investors here and in Korea, is why is that so important to the average investor? What kind of advantages does it provide over, say, a statement that I can get now from a Schwab or a JP Morgan, where I can see almost all my investments, I should say, on one page?
Yes.
Why is tokenization important, and what kind of additional risks are there if we start to tokenize things?
Yes, and you've almost answered your own question in the setup there, Ty. So,
no, I want you to answer it since you're the expert.
That's good, right? So when you look at your statement, you said it yourself, it has almost all your assets, right? And in essence, what you've had to do is you've probably had to input or link in some of those assets. So if you think about it, we live in a world today where there's lots of accounts. I have a checking account. I have a savings account. I have a brokerage account. I have an investment account. I have probably a retirement account. I might have a retirement savings account separate from my work retirement account, right? I have a house that has a title, right? All of these assets are part of my wealth that needs to be managed, but they sit in very different buckets, right? Now, before you talk about why tokenization is important, you have to realize that the reason we want to tokenize assets is to be able to put them into a wallet, right? A wallet is really going to become the key piece of our financial infrastructure in the future. Instead of having 5 or 6 or 8 or more accounts like I have today, in the future, I'm going to have one cryptographically protected piece of software that can actually hold the records of all my assets. And that is called a cryptographic wallet. And in that wallet, once my assets are all in that wallet, I automatically get rid of all the little silos and buckets that exist today. And all of a sudden, all my assets are in the same container, and I can start to optimize them against each other. I can't use the cash in my checking account to sweep into the overnight money market fund that I might get yield on in my brokerage account, because they're in 2 separate accounts today. But if they were all sitting in my wallet, I would get the benefit of being able to aggregate all of those different assets together. And this is why tokenization is important, because I need to tokenize the assets in order for them to sit in the wallet. And that is why I think tokenization is going to open up all these opportunities, the opportunities for me to better use my cash, the opportunity for me to lend my assets and earn extra fees, the opportunity for me to be able to use my assets to take out derivative positions to hedge against my downside or to increase my upside exposure. All of this is going to become so much easier to do when assets are tokenized and they sit in the same wallet.
When you explain that, it makes a lot of sense that I can actually, if I have extra balances sitting in my checking account, I keep a certain amount of, as you say, I have a separate checking account, I have a brokerage account, I have a crypto account, and they're all in sorts of different places. I'm very careful to let the family know where everything else, God forbid anything should happen. Yeah. But and you can sweep whatever I have in my checking account. Why don't I earn a little bit of interest in that overnight instead of it just letting it sit there and benefit J.P. Morgan, so to speak? But it does worry me, and I like to think that I'm relatively advanced. That something is sitting on a cryptographical wallet, and I think in one of maybe it was futuresportfolios.com where you did that wonderful series on what's ahead for the investment world in the next 5-10 years or so. Sort of, you have a public wallet and a public key, and then you own the private key and you can access it. But I always worry, what if I lose that private key? And if there's a problem with my Franklin Templeton account, I'm going to call Sandy. Well, I won't exactly call Sandy. I'll call somebody at Franklin and say, hey, help me out with this. I lost my password. But if something's tokenized, who am I going to call for help? Would I be able to, say, put everything at Franklin, and then Franklin becomes sort of the custodian of my public and private keys? Because I'll tell you, that would make me a lot more comfortable if there was someone I could call.
Yeah. So first off, the great news, Ty, is there will absolutely be someone you could call, right? This idea about owning a public key and losing it, you using your private key and not being able to get at your assets, that was from the very, very early days of crypto, when people only had the option of self-custodying their assets. That is not the way that the system is likely going to work in the future, right? In the future, there is going to be your brokerage firm, whether that's Schwab, like you were using in your other example, whether that's someone like a Franklin Templeton, who's an investment manager, whether that is, someone that you contract for third-party service, right? They will be able to take control of your key. And what they do to protect it, it's really interesting, is they break it into hundreds of pieces. And each piece is constantly cycling through these cryptographic algorithms. And think of them as almost tumblers, like a safe. And it's only when all the tumblers line up that the key actually works. And therefore, algorithms and AI-driven agentic algorithms manage scrambling the keys, and it's only in one moment of time that the key comes together, when you're actually authorizing a transaction. And other than that, your key does not even exist as a key. It's hundreds of little pieces that they have to gather back together. So there has started to be a very sophisticated way of managing these keys. And what's great to know is that the only thing that sits in your cryptographic wallet is the key. All of your assets are held on blockchain ledgers, which are backed up where you can see every transaction throughout the entire history of the ledger. So it's a lot of technical jargon to really understand it in depth, but I can tell you that the way that the technology is going is, to you or I, it's going to feel just like your Schwab statement today. But instead of having 7 or 8 or 9 different account numbers, it's going to have one listing of assets, and you're going to be able to use each of those assets better, but it's still going to feel like it's coming to you through a trusted party. And that trusted party is going to be able to manage your assets much in the way they do today. Already at Franklin Templeton, if somebody is invested in one of our tokenized funds and for whatever reason they can't get into their wallet was compromised, they lost their wallet, right? They lost their wallet address. It never would happen, but even if it were, we can cancel their tokens that they had and reissue them tokens in a new wallet. There's a lot of protections being built into this system that's going to make it feel very safe for consumers. And I like to think about, I mean, I'm old enough to remember, I used to be afraid to pay for anything over the internet. It felt very dangerous. I couldn't put my credit card out on the internet, right? And, now that's become so commonplace because we trust the security that's there. And this security that protects these cryptographic wallets is way better than the security we trust to protect our credit card numbers today.
I still use PayPal if there's a website I'm not sure about. I just want that that person standing in. So right. I like the way you described it. So if a client were to open a cryptographic wallet at Franklin Templeton, I'm not sure if it exists fully yet, but would it be just like logging into Franklin Templeton, or maybe having an authenticator app or something, give me a number that I can punch in? Would it be really as simple as that?
It already is, right? So here in the US, if you're a US citizen, you can download this app from the App Store called Benji, BENJI, which is our app for our tokenized money market fund. And you answer a few simple questions on the setup screen, and then you wire money into your account, and you're able to buy and sell money market funds from an app that sits right on your phone. But in reality, it feels like an app experience, but underneath it is our set of cryptographic wallets that we're managing on behalf of our clients. And we are managing all the keys to the wallet accounts so that their assets are being kept safe. But to you as the consumer, it just feels like a regular app that you would go on to buy or sell a security.
I think it'd probably help the industry to advertise that better, to describe it just the way you've described it. Because when you say cryptographic wallet, I think it makes people nervous, and you think of a chip. And what if I lose this? This chip, and what happens? And I lose my. I guess you've read. I've read stories about people who've lost the key, and they had X number of Bitcoin. And now there's only 3 more codes they can possibly put in. I think, and otherwise they'll lose all that Bitcoin forever. I think that scares people. And I think
scares me, right? Wouldn't that scare you?
Exactly. And I think this is a really interesting, way of getting the message out that all the stuff actually happens in the background. Your cryptographic wallet will reside here, and it's that there is someone to call. I think that's so important, because coming from someone whose mother was a first generation immigrant, and if she didn't have her passbook, they got rid of the passbooks, and she was bereft almost, because what happens? There's no physical something that I can hold. But the world changes and technology gets better. You did mention something, and I wanted to ask you about it, that it can allow people to invest in things that they've never been able to invest in. And I think you said IP rights and and other assets like that, or art. Is that, in terms of for Franklin Templeton or somebody similar, is there in compliance concerns where should you let's say come sometime I want to somebody has a piece of art and I want to buy some small share in that piece of art, would it be Franklin's responsibility to make sure that that art is sort of legitimately held? Does that open you to a lot more responsibility in terms of odd things that people own now that they never used to?
100%, right? And that is our responsibility, Ty, as an asset manager, right? We would never offer an asset to offer, for people to invest their money in if we were not sure of 4 things, right? I always tell people 4 things you have to be sure of. The authenticity of the asset has to be verified. The storage and the existence of the asset in the storage has to be verified. The valuation of that asset has to be done by a third party. We can't set the price of that asset, right? It has to be independently set as an asset price. And then the 4th thing is that there has to be an ability to track and to really be able to be very precise about who all the various owners are and where they are holding their shares, right? You don't want to ever be worried that any investment is not being completely 100% tracked at all times, right? So one of the reasons that these assets have been hard to bring into investment portfolios is that there has not been those four safeguards that make them easy to use as an asset, right? That's why it's easy to invest in an equity or stocks, because they have all of those different controls in place. So part of what our innovation team is doing is making sure, can we use these new technologies to build certainty around the verification of the asset, the storage of the asset, the valuation of the asset, and the tracking of the ownership of the asset, right? So these are all problems that we have to solve. And the only reason we're tackling them now is that these new technologies give us an ability to answer some of those questions with a lot of confidence. And that's why we think we're going to be able to bring these out as new types of assets. But by the time we offered a fund like that, you can rest assured that we would have 100% control and visibility of that asset, and 100% ability to take you as our customer and be able to protect that investment on your behalf.
Those four things sound like a tremendous lift in terms of being able to verify that everything that you offer is legitimate. It's not going to be second to second if it's a piece of art, but you can value it on a continuing, reliable basis. That's a big lift. Sounds like a massive investment in teams of people as well as technology.
Yeah, and that's why, it's something that we have to prioritize and spend time planning and building and experimenting with, because by the time we offer it to our customers, we have to have 100% confidence that the system is going to work, and that this is an add to your portfolio, right? There's no point in us offering these products unless we feel like it's going to enhance your diversification and allow you to build wealth in a safer way. And so, we don't mind putting that time in, because, it's opening up new markets, but we can't open up those markets if it's going to create risk for our clients. That's our most important value that we deliver, is trustworthiness, that we're going to manage the assets safely. And so, putting the time in to build out new offerings, that's something that's part of our own research and development that we feel is important to keep growing as an industry.
So for example, let's say some point in the future, I have my Franklin account, and I own a piece of some art that I bought that outside of Franklin's purview. Would I be able to place that in the wallet? Because perhaps you haven't vetted it as fully as you just described. Would I be able to bring other things that weren't originally in the wallet, or maybe not a Franklin product or service? Would I be able to put that in the wallet, keep it all in one place?
So that's one of the most exciting aspects of thinking about what the future would look like with a wallet, because the answer to that is absolutely yes. So we would have a framework that you could bring any asset into, and be able to then do the due diligence and the evaluation of that asset, and really be able to bring it into the portfolio. And therefore, then it becomes part of our calculations about how diversified you are. And it's not going to just be potentially a piece of art. It could be the value, the equity that you've built up in your home. It could be, any assets that you own in terms of, a nice car, right? You can really bring the entirety of a client's wealth into their investment portfolio and think of that as one set of assets.
In terms of just rough time frames, because predictions are hard, especially predictions about the future, is how long before you have a substantial number, or maybe it exists now and I'm just behind the times, clients who actually have a lot of their portfolio in a cryptographic wallet? How long do you think will be before that is a reality?
I think that for a lot of younger investors, they probably have some assets already. I would say probably 30 to 40% of younger investors have some assets in a wallet. Typically, that would be like Bitcoin or Ethereum or other crypto wallets, right? Crypto assets that sit in a wallet. So if you look at a platform like Robinhood, right, you can trade your stocks on Robinhood, but I can also trade crypto on Robinhood. And the stocks that I trade on Robinhood sit in a regular account, but the crypto that I trade on Robinhood already sits in a wallet, right? So I'd say that we're starting to see the penetration, but just in a narrow segment right now. I do think within the next 5 years, we will see more and more regular equities and regular ETFs and regular funds sitting in wallets. And this is something that we are working on with many clients today, is how do they deploy that wallet system to be able to start offering their clients an ability to move assets into the wallet and tokenize them. So I think that you will see a gradual buildup over the next 5 years or so, and then it's going to start to become a pretty common offering.
You said something that pretty interesting in terms of you mentioned ETFs and sort of other products, and as I'm sure you know, the universe of ETFs has become vast. I think there was a Bloomberg article recently that said there are more indices and more ETFs than there are listed equities in the in the universe, which thinks that which this author found perhaps a little troublesome, because when you ETF stuff and you put that nice wrapper on it to make it really easy for people to trade, then you sort of combine the good and the bad. My thinking of is, if you buy the Russell 2000, for example, which is, you can buy an ETF on the index, 2/3 of the companies, or actually I shouldn't say that, it's probably about 45% of the companies don't make any money. So when you put things in wrappers, you're potentially misallocating capital to people who may not deserve it. So in terms of this whole thing about ETFs and indices, what do you think? Have we gone a little too far about that, or with that, or should we just do it in a more smart way, or have better products?
Yeah, I mean, look, there has been a huge, as you say, a huge explosion in the number of indices. And that's because a lot of firms are creating their own custom indices, their own custom benchmarks, right? And that's really contributing to this. This is where tokenization offers a really interesting answer, right? The ETF structure, what's interesting about the ETF structure is it's a way for me to buy a whole set of securities at once, right? When I buy the Russell 2000, I'm getting a proportionate share of 2,000 different securities. What's interesting is with tokenization, I don't necessarily need the ETF wrapper anymore, right? If each of those 2,000 stocks in the Russell 2000 were tokenized, I could buy a proportionate share of the tokens, and I could wrap those 2,000 tokens in another token, right? That then transports all 2,000. And if I wanted to get at the individual securities, and let's say I don't want to hold all of the stocks in the Russell 2000 that aren't generating any revenue, I could then unwrap, I could burn the token that transported the 2,000 stocks, and I could have all 2,000 stocks in my wallet, and I could just give an instruction to sell all of those stocks that didn't produce positive net revenue in the past 3 years, right? And that becomes a very easy transaction to enact, and it creates a lot more flexibility for me as an individual in my portfolio, but I just don't have that degree of control today. And so ETFs were very helpful because it allowed me to get at big sets of securities very easily as an individual. But now some of the downside of that is that there's so many indices that it becomes hard to know what to invest in.
Right, right. In terms of the fees, there's certainly not very many transaction fees, at least with sort of the listed equities, because it was a little bit of a race to the bottom.
Yeah.
There's so much, Franklin or somebody else does it. It just seems that it's so much work and so much investment. How do you, sort of make the fees back, so to speak? How do you make back this investment? Do you charge management fees on accounts? Certainly, it's amazing things that you're doing, but those things cost money, and the technology is expensive.
Yeah, absolutely. And as an asset manager, We do charge a management fee on the portfolios that we manage for you. But this is where the technology is also super helpful for us, right? Because that cost of service, that cost of creating the portfolio, that cost of managing the portfolio for you, that is what we are using a lot of these new technologies to cut dramatically, right? Being able to use the blockchain, which is a public ledger, to do record keeping in a secure way, it allows us to cut a lot of fees out of what it costs for us to actually administer a transaction. And so using these technologies is going to allow us to actually improve our margins and keep fees low or potentially even lower, because our cost of running that portfolio is going down because these technologies are making that so much cheaper.
Just to, taking one quick step back, when you say, you talk about the blockchain and the public ledger, and there are a lot of folks who, for whom those words just still are a little scary. This is, as if instead of having an account with, let's say, my account with Schwab, it's really the data is between me and Schwab. The public ledger is basically everywhere. You don't have a single point of failure. Would that be accurate to say?
Yeah. That's exactly right. And it's also viewable by all the counterparties. So today, if you have an account at Schwab and you're buying a security, and the company that you're buying that security from is, let's say, Vanguard, right? There's an entire day-long or more process where Vanguard has to reconcile their records with Schwab's records to make sure that everybody agrees that Vanguard has the stock to sell and that Schwab is able to have the money to send to pay for the stock, and then to figure out what accounts it goes into, right? So that is a time-consuming process. There's people whose entire job it is to do that reconciliation of those accounts. If those transactions happened on a public ledger, there would be two wallets that had completely anonymized addresses, just a string of letters and numbers. And the blockchain itself, the node operators that operate the blockchain would check one wallet to make sure it has the asset. It would check the other wallet to make sure it has the money to pay for it. And if that was correct and both wallet owners signed their transaction with their private key, that trade would happen immediately, right? There's no need for people to reconcile two different sets of books and records. There's no need for people to realize, oh, I spelled your last name with an A, not an O, and therefore I can't get the record to match, right? That's not going to be a problem in the future. And this is why it's going to be much cheaper for us to run the financial system on these new rails.
Just staying with that for a second, when we say the blockchain, is there more than one blockchain? There are multiple blockchains that are publicly accessible. Are there certain ones that are dominant right now? And if so, what are they? And then, if I'm not putting you in a difficult position, but what are the main blockchains? And then how do you see that evolving? Will there be many blockchains going forward, or will they sort of coalesce and become a handful?
Yeah, there are many, many blockchains today, right? Most people are familiar with Bitcoin. Bitcoin is not this kind of blockchain, right? So when you talk about Bitcoin, Bitcoin is more of like a digital form of gold. The kind of blockchain that we're talking about, where you record these transactions for the public, that would be something like Ethereum is probably the largest blockchain that people use today. Some of the other leading blockchains are Solana and Ripple and Avalanche. These are some of the bigger blockchains that people use today. Just to give you a sense, Ty, Franklin Templeton, we've connected our system that we use to issue tokens and manage them. We've connected that to 10 different public blockchains and one private blockchain. So I think that there will be several. There's not going to be hundreds, but I think there will be probably a couple handfuls of blockchains, and people will use them for different purposes, and they have different economics associated with them. But what they have in common is that they are all sharing the ledger. So every transactor sees the same records, which makes it much easier for us to be able to do transactions effectively in the world.
Wow, this has been really, really sort of useful and loose today. And I just want to go down the blockchain rabbit hole just a little bit more. You said that eventually there'll be perhaps a handful of big ones, but not hundreds. So let's say one of the blockchains, the public blockchains, becomes sort of eventually almost obsolete. The usage goes down, costs too much. What happens to the data that was resident on that blockchain? Will that always exist, or will it get ported over to some other blockchain? Or at some stage, if it's a transaction that happened 10 years ago, that's no longer important because it's been sort of superseded by transactions that afterwards? How would that work?
Yeah. So one of the great things about blockchain technology, and one of the reasons we believe it is going to be so powerful, is that every transaction that is ever done on a blockchain is linked to each other. That's why they call it a chain, right? Each block is a set of transactions. Let's just say there's 200 transactions in every block. Every block is chained together to the blocks that came before it. So I can trace my transaction history all the way back to what they call as the Genesis trade, the very first trade that ever happened on the blockchain. So think about today, if I have to go back and find a transaction that I did 5 years ago, that's going to take me a lot of research and a lot of digging to figure out that transaction. On a blockchain, I could do that immediately, right? I just go into the blockchain explorer, I type in the approximate date I think it happened, the time, the wallet address, and it will come right up, right? So every transaction is preserved and every transaction is chained together so you can recreate all of the transactions. So if a blockchain were to become obsolete, or if it were to start to wind down and there wasn't much interest or activity in that anymore, people could take the entire record of that blockchain and port it into a new blockchain, right? So those records would continue to exist. And we see this happen already. People clone blockchains and start new ones using the same exact code that they used to create the first blockchain. So this technology is very, very flexible in that way.
Wow, that's brilliant. And I'm sorry to make the more blockchain focused, but you're explaining in such an easy and simple way that it's so. I promise. One more question:
Sure.
who owns some of these blockchains, and would Franklin potentially or somebody else have their own blockchain sometime in the future?
Yeah. So the original blockchains, right? So Ethereum and Solana, all these blockchains that I had mentioned previously, Bitcoin as well, right? They were owned by foundations, right? They are not companies. They are set up by foundations. And basically, everyone who owns those tokens is an owner of the blockchain. So if I buy Ethereum and I have Ethereum in my wallet, I am a partial owner of the Ethereum blockchain, right? So it's a different structure than a company, right? I can buy shares in a company, but the assets are still the company's assets. When I buy tokens of a blockchain, I actually own part of the network, right? So it's a way of owning a network, right? If you think of stocks as a way of owning a company, cryptocurrencies are a way of owning a network. And so everyone, who owns cryptocurrencies owns part of the network of that cryptocurrency. So there's starting to be some companies that are trying to launch their own blockchain. So Coinbase has launched a blockchain called Base. Circle, which is a stable coin, has just launched a blockchain called Arc. Robinhood has announced that they're going to launch their own blockchain. I'm not sure if the company-owned blockchains will have the same utility and find the same use cases as public blockchains, right? Part of what makes a blockchain very special is that no one person or no one entity owns them. All the participants own them. When you talk about these chains that are being issued by a specific company, that company is still going to own the chain. And I think that may prevent others from seeing as much benefit in using those chains as using the public chains. So it's a newer phenomena, and I think we're going to have to watch and see how it develops. But my gut is telling me that public blockchains are still going to be more the utility that we need to really improve the way transactions occur in the future.
I'm mindful of your time, but I do want to step back and ask a question or two about investments. And I looked at your futureportfolios.com, and I wonder if you're going to update it for this year, because it looks like it was from really great survey from last year. And as Americans, we're sort of infamously ethnocentric, or we only think of America, we never think of EMEA, we don't think of Asia. And it looks like you surveyed a lot of money managers. I think it was $50 trillion worth of people of asset managers and investors in different places. How are people outside the U.S. thinking about investing and the next stage of investing, say in Asia or EMEA? Are they well ahead of Americans in what they're thinking, or are there some specific ideas that they have or they're using that we should be thinking about?
Yeah, so it's interesting. In EMEA, they have moved very quickly to wallet-based investing, and that is becoming more and more common, and there are more and more digital assets being held in portfolios in Asia than probably Asia and Latin America, probably more than anywhere else in the world. They have really been at the forefront of driving a lot of these trends. EMEA is starting to follow. They've actually rolled out a wallet-based system for all of the countries in the European Union, and they're going to actually manage the identity of people in the European Union through their wallet system. So they're also making strides in using wallets. Believe it or not, in a sense, the US has actually been the farthest behind. And part of that is that, the Biden administration was very negative on crypto, and therefore they did not really separate crypto out from some of these underlying technologies like blockchain, and really encourage the innovation in blockchain that we've been seeing and the innovation using wallets that we've been seeing elsewhere in the world. But we are now starting to make up that gap. And I think as a result, you're seeing differences between different regions in the world beginning to narrow. And this is really going to be a global system, right? If I'm using the Ethereum blockchain to record transactions, it doesn't matter if I'm transacting from Latin America or Asia or EMEA or the Middle East or the US. It's all going on to the same ledger. And so in a sense, these are going to be global systems.
That's really, it doesn't surprise me that America's behind. I suppose one reason is we are so institutionally strong that we have a lot of trust in things that they're already existing. But you mentioned Latin America, and some of those countries perhaps are not as stable as the U.S. In which case, if you can put something on a blockchain, a public ledger, it's actually probably more secure than having it on your having it at your local bank.
100%.
That's really interesting in terms of how they're leading the entire process. Well, thank you so much, Sandy, for spending this time with us. It's really been very educational. I look forward to speaking to you again, and I wish you a very, very happy holiday season.
Thank you so much. It was a wonderful conversation. Thank you for having me, and I'd love to come back again. And you have a wonderful holiday season as well.